Selling your investment property, don't spend all your proceeds straight away. You may need to keep some of it for tax at the end of the year. Are you selling your investment property? Be sure to talk to your accountant before you spend all your proceeds. Why? Because some of those proceeds may need to be withheld and put aside for tax to be paid when you lodge your tax return, especially if you own your investment property in your individual name. Why? Because the gain from your rental property is added onto your ordinary income. Ordinary income being your wages income or the like, for simplicity's sake. So what happens is if you make, as an example, a $100,000 gain on your rental property, then that's added on top of your wage for tax purposes. So let's dial it back. If ordinarily your wages income is $100,000 a year, then you have a set marginal rate that you pay your tax on. Now, we all understand that the more you earn, the higher tax you pay. Your tax percentage goes up. So if we're adding a capital gain onto that ordinary income of your wages, then your tax rate is going to go up. Now, yes, there is capital gains discount and there's other factors to consider when working out your actual gain on your investment property if you have a gain. We're talking simplicity's sake that you do have a gain and that all deductions and discounts are being taken into consideration. What happens is if your wages income of $100,000 was at X percent, say 30% tax rate, and then your rental property added another $100,000 of income to your taxable income that year, then your tax rate could jump up to 45%. So that's a big difference in tax. The issue is that you need to pay that when you lodge your tax return or when the tax return is due. You might sell your investment property at the start of the financial year and not have to pay that tax for another 12 or 18 months. So it's quite important to do those calculations of how much tax you need to pay so you can put it aside and not spend it from your sale proceeds. A lot of people make the mistake of receiving the sale proceeds from the lawyer upon settlement and spending it or using it to buy another investment property without considering how much of that money they need to retain. It's also important to understand that what you receive from the lawyer on settlement day as your proceeds is not your gain. Your capital gain is a completely different calculation, which takes into consideration your cost base, your expenses along the way, which have been capitalized, and the net proceeds that you've received on settlement day. It's a big calculation. It could be completely different to what you think your gain is. It's important to talk to your accountant when you sell your property or when you're about to sell your property to do those calculations. The timing of selling your property can also be important because depending upon your income for that financial year, in some situations, it might actually be worthwhile to hold out selling your investment property until the new financial year if your income is going to be different from wages next year. The bottom line is, you need to start the conversation because every single time it's scenario based, it's different. There isn't a one rule or one percentage to apply when selling. It's based on your individual situation, your income for that year, and what the gain is. It depends what you bought the property for, how long ago you bought it for. Have you made any improvements? Have you claimed those deductions for those improvements or have you capitalized them? There's many factors that need to be considered. It's not simply what you paid the real estate when you bought it versus what you received when you sold it. I always encourage our clients to reach out when they're looking to sell their investment property so we can do some scenarios and tax planning for them based on the various outcomes. It can also impact the amount that they list their property for sale for because the more they sell it for will result in more of a gain. And so we can provide them with that scenario so that they go to the real estate agent knowing if they sell it for X amount, they may have to pay this much tax. If they sell it for this much, they have to pay this much tax. It can demonstrate to them that it might not be worth reaching that extra $10,000 or $20,000 sale because it may result in an extra $5,000 tax payable. But at least they're armed with this information to make those decisions and have those conversations with the real estate. So when they're negotiating with the person buying the property, they understand the net effect to them. Because $10,000 more of a sale does not mean $10,000 more in their pocket. You got real estate fees, tax, all these other considerations to make. So I always encourage our clients to have those conversations with us, do the tax planning exercises, consider their income for that financial year, and understand the estimated outcome from these rental property sales. So talk to us or talk to your accountant so that you don't receive a shock bill at the end of the financial year when you lodge your tax return. More importantly, it's smart to have this understanding when you sell your property so that you can hold on to that tax and put it aside ready for a payment at a later date. I've heard too many stories of people selling their investment property, spending the money or reinvesting it, and then come tax time have to come up with large amounts of tax to pay, which relate to that sale. And then they don't have that money because they've spent it or reinvested it, and they get themselves in tax trouble. So avoid that situation, be proactive, have those conversations with your accountant when you're looking to sell. If this video opened your eyes up about investment properties, be sure to check out our other videos.